Hello, welcome to Capital Sensei. Today we're diving into one of the most important books of the last decade for anyone interested in making better decisions, especially with their money. We're going to unpack the key ideas from The Signal and the Noise by Nate Silver. We'll explore why we are drowning in information but starving for wisdom. How to tell the difference between a meaningful trend and random chaos, and how you can apply these lessons to become a smarter, more rational investor. Whenever we can, we try to answer questions left in the comments. Learning about finance and the economy is a journey, and hearing your stories and experiences is incredibly valuable for everyone. So please, feel free to share your thoughts or ask anything that's on your mind. You'll be helping build a community of curious minds right here. So let's get straight to the heart of the matter. The central theme of Nate Silver's book is the difference between signal and noise. What does that even mean? Imagine you're trying to tune an old-school analog radio. You're turning the dial, and most of what you hear is static, that fuzzy, crackling sound. That's the noise. But then, you hit a sweet spot, and a clear voice or a piece of music comes through. That, my friends, is the signal. In our modern world, we are bombarded with an incredible amount of information every single day. News headlines, stock market tickers, expert opinions, social media trends. It's a constant flood. Most of that is just noise, random fluctuations, misleading data, and plain old useless information. The signal is the truth, the underlying reality, the real pattern that can help us understand the world and make accurate predictions. The challenge, and the whole point of the book, is that the more information we get, the more noise we have to sift through to find that elusive signal. We've experienced an explosion of data in the last couple of decades. Our ability to collect and store information has grown exponentially. You'd think this would make us fantastic predictors of the future, right? More data should mean more clarity. But that's not what happened. In many fields, our predictions haven't gotten much better, and in some cases, they've gotten worse. This is the great paradox of the information age. We have more raw material than ever, but we're not much better at building anything useful with it. Why is that? Because we get distracted by the noise. We see a stock jump 5% in one day and think it's a sign of a huge breakthrough, a strong signal. But it could just be random market volatility, pure noise. We hear one economist predict a recession and we panic, but he might be one of 100 economists, 99 of whom are saying the opposite. We mistake confidence for competence, and a compelling story for cold, hard fact. Finding the signal is about being a detective, not just a passive listener. Let's look at a field where prediction has gotten remarkably better: weather forecasting. This is one of Silver's primary examples of a success story. A 4-day weather forecast today is as accurate as a 1-day forecast was back in 1980. That's a massive improvement. Why did meteorologists succeed where so many others failed? It wasn't just about having more powerful computers, though that certainly helped. The key ingredients were twofold. First, they had a culture of probabilistic thinking. A good weather forecast doesn't say it will rain tomorrow. It says there is a 70% chance of rain. This is huge. It acknowledges uncertainty. It gives you a measure of confidence. Saying something will definitely happen is the mark of a salesman, not a scientist. Saying there's a 70% chance is providing useful, actionable information. You might decide to bring an umbrella, just in case. Second, and just as important, is the feedback loop. Every single day, meteorologists make a prediction, and the next day, they find out if they were right or wrong. The atmosphere doesn't care about their feelings or their political biases. It provides immediate, unbiased feedback. This constant cycle of prediction, result, and analysis allows them to relentlessly refine their models. They learn from their mistakes in real time, which is the fastest way to improve. Now, let's contrast that with my own field, economics. As an economist, I can tell you, our track record with forecasting is, well, let's just say it's humbling. Economists are notoriously bad at predicting recessions, market crashes, or even something as simple as next year's gross domestic product growth. We have tons of data, sophisticated models, and brilliant people. Yet our performance is often no better than a coin flip. Why the stark difference from weather forecasting? The economy isn't a physical system like the atmosphere. It's a human system, and humans are messy. The economy is driven by psychology, by fear and greed, by irrational exuberance, and by sudden panics. These things are incredibly difficult to model. Furthermore, unlike the weather, the forecast itself can change the outcome. If a prominent economist predicts a recession, people might get scared, stop spending, and in doing so, actually cause the recession they were warned about. This is a concept called reflexivity, and it's a forecaster's nightmare. The 2008 financial crisis is the ultimate case study here. Almost no mainstream economists saw it coming. The credit rating agencies, the so-called watchdogs, were giving AAA ratings, the highest seal of approval, to mortgage-backed securities that were essentially ticking time bombs. They were drowning in data about these assets, but completely missed the real signal: that the entire system was built on a foundation of shaky, subprime loans. They mistook the noise of rising house prices for a signal of permanent safety. So how can we, as investors and decision makers, do better? Nate Silver champions a way of thinking called Bayesian reasoning or Bayesian updating. Now, don't let the fancy names scare you. The concept is actually incredibly simple and intuitive. It's probably how you already make decisions. You just don't have a name for it. Bayesian thinking is all about updating your beliefs in the face of new evidence. You start with an initial belief, what's called a prior. This is your best guess based on what you currently know. Then, as new, credible information comes in, you adjust your belief. You don't throw out your old belief entirely, and you don't blindly accept the new information. You integrate it. Let's use a non-financial example. Imagine you think there's about a 20% chance your friend will be late for dinner. That's your prior belief, based on past experience. Then you get a text from them that says, "Stuck in crazy traffic." This is new evidence. Now you update your belief. You'd probably say, "Okay, now I think there's a 75% chance they're going to be late." You've just performed a Bayesian update. This is the exact opposite of how many people approach the world. A lot of us form a strong opinion and then spend all our time looking for evidence that confirms it, while ignoring anything that contradicts it. This is called confirmation bias, and it's a portfolio killer. A Bayesian thinker is always asking, what new information would cause me to change my mind? They are humble and flexible. For an investor, this means your thesis about a company should never be set in stone. It should be a living document that you are constantly updating as the company releases earnings reports, as competitors make moves, and as the economy changes. Silver uses a fantastic analogy to illustrate two different types of problems: chess versus poker. Understanding this difference is critical for investing. Chess is a game of perfect information. The board is right there. All the pieces are visible, and there are no hidden cards or dice rolls. There is no luck involved. The winner is the person who can calculate more effectively and see more moves ahead. The signal is crystal clear. There is virtually no noise. Poker, on the other hand, is a game of incomplete information and luck. You don't know what cards your opponents are holding. You don't know what card will come next on the river. You have to make decisions based on probabilities and by reading your opponents. You can make the absolute perfect decision, the mathematically correct play, and still lose the hand because of bad luck. That's the noise of the random shuffle. For a long time, people thought investing was like chess. They thought if you were just smart enough and had enough data, you could solve the market. But the reality is that investing is overwhelmingly like poker. You are making decisions with incomplete information. There is a huge element of luck, or noise, in short-term market movements. A great company can see its stock fall because of a random geopolitical event. A terrible company can see its stock soar on a wave of irrational hype. The lesson here for investors is profound. You have to learn to distinguish the quality of your decision-making process from the quality of the outcome. In poker, a professional player knows they made the right bet, even if they lost the hand. In investing, you need to have a sound process based on fundamentals and probabilities, and you need to stick to it, even if you lose money on a few trades. Over the long run, a good process will win out, just as a professional poker player will win out over a tourist. Don't judge your decisions solely by their short-term results. Let's turn to another one of Silver's success stories: baseball. For about a century, baseball scouts evaluated players based on gut feeling and conventional wisdom. They looked for players who looked the part: tall, athletic, with a good face. This was the noise. The signal, they thought, was in these subjective assessments. But then came a revolution, popularized by the book and movie Moneyball. A group of statistically minded outsiders, led by figures like Bill James and Billy Beane, decided to ignore the noise and focus only on the data. They asked a simple question: what measurable actions on a baseball field actually lead to winning games? They found that things like on-base percentage and slugging percentage, objective numbers, were far better predictors of success than a scout's subjective opinion about a player's swing. They found a true signal in the data. By signing players who were undervalued by traditional scouts but had great underlying statistics, the cash-strapped Oakland Athletics were able to compete with big market teams like the New York Yankees. They were, in effect, arbitraging the market's inefficiencies, buying assets for less than their true worth. Doesn't that sound exactly like what a good value investor tries to do? The parallel to investing is direct. The market is full of scouts, pundits on television, analysts with strong buy ratings, your brother-in-law's hot stock tip. This is all narrative and gut feeling. It's the noise. The Moneyball approach to investing is to ignore all that and focus on the fundamentals. What is the company's revenue growth? What are its profit margins? How much debt does it have? Is its price-to-earnings ratio reasonable compared to its peers? These are the objective statistics that, over the long term, are the real signal of a company's value. To help us categorize different types of thinkers and forecasters, Silver borrows a brilliant concept from the philosopher Isaiah Berlin, the fox and the hedgehog. Berlin once wrote, "The fox knows many things, but the hedgehog knows one big thing." This is a powerful metaphor for how people approach prediction. The hedgehog is a thinker who views the world through the lens of a single, overarching idea. They have a grand theory that explains everything. Think of the hardcore gold bug who believes every economic problem can be solved by returning to the gold standard, or the extreme free marketeer who thinks all regulation is evil, always. These hedgehogs are often very confident, charismatic, and great on television. They have a simple, clean story. The problem is, The world is not simple or clean. When reality doesn't fit their model, they don't change the model. They insist reality is wrong. The fox, on the other hand, is a more cautious and nimble thinker. They don't have one grand theory. Instead, they know many small things. They draw on ideas from different disciplines. They are comfortable with nuance, complexity, and uncertainty. They are self-critical, always questioning their own assumptions. They are constantly updating their beliefs in a Bayesian way. Nate Silver's research and the research of others, like Philip Tetlock, shows conclusively that foxes are vastly better forecasters than hedgehogs. Their predictions are more accurate and better calibrated. So, as an investor, you should strive to be a fox. Don't get married to one single investment philosophy. Don't believe anyone who tells you they have a foolproof system. Be skeptical, be curious, read widely, and be willing to admit when you're wrong. A hedgehog might feel smarter, but a fox will end up richer. There's another critical trap that Silver highlights, which is especially dangerous in finance. It's a statistical concept called overfitting. Again, let's not get bogged down by the jargon. The idea is simple. Overfitting happens when you create a model or an explanation that is too complicated and tailored too perfectly to past data. It ends up mistaking the noise for the signal. Imagine you have a chart of a stock's price over the last year. You could draw a very simple, straight trend line through the data. This line captures the general direction, the signal. Or you could draw a crazy squiggly line that perfectly hits every single up and down tick of the stock's price. This second line is overfit. It looks like a perfect explanation of the past, but it has zero predictive power for the future because it has perfectly modeled all the random noise. Financial quants and amateur traders fall into this trap all the time. They build complex trading algorithms with dozens of variables that would have worked perfectly over the last 5 years. They backtest it and it shows amazing returns. But when they try to use it in the real world, it fails miserably. Why? Because it was just a complicated recipe for capitalizing on the specific random noise of the past 5 years. When the nature of the noise changes, the model breaks. The lesson is that simpler is often better. A good model, whether it's for investing or anything else, should be robust. It should capture the true underlying signal without getting fooled by the noise. Albert Einstein supposedly said, "Everything should be made as simple as possible, but not simpler." For investors, this means focusing on a few key, time-tested principles. Buy good businesses at fair prices, diversify your holdings, and think long-term. This simple model is far more likely to work than some complex, overfit trading system you found on the internet. So, after all this, what are the concrete, practical takeaways for you, the everyday person trying to make smart decisions with your money? Let's try to distill this down into a few core principles derived from Silver's work. First, and perhaps most importantly, learn to think in probabilities. Banish words like certainty, guaranteed, and definitely from your financial vocabulary. Nothing is 100% certain. Instead of asking, "Will this stock go up?" ask, "What is the probability this stock will go up? What is the potential upside if it does? And what is the potential downside if it doesn't?" This probabilistic mindset forces you to acknowledge risk and make more rational trade-offs. Second, actively seek out disagreement and disconfirming evidence. When you are considering an investment, your natural tendency will be to look for reasons why you are right. You have to fight this urge. Make an effort to find the smartest people who hold the opposite view. Read the bearish case for the stock. What are they seeing that you're not? This isn't about being negative. It's about being rigorous. A good decision is one that has survived a trial by fire. If your investment thesis still holds up after you've tried your best to poke holes in it, your confidence should be much higher. Third, be incredibly wary of narratives and stories. The human brain is wired for stories, not for spreadsheets. A company with a charismatic chief executive officer and a grand vision for changing the world is much more appealing than a boring company that just makes nuts and bolts. Even if the bolt company is a far better investment, the story is often the noise. The numbers, the cash flow, the balance sheet, that's where you'll find the signal. Learn to fall in love with a good balance sheet, not a good story. Fourth, embrace the fox mindset. Be a generalist. Read about history, psychology, and science, not just finance. The best investors, like Warren Buffett and Charlie Munger, are learning machines with a wide range of knowledge. This gives them a rich toolkit of mental models to understand the world. Don't be a hedgehog with just one hammer, looking at every problem as if it were a nail. The more models you have in your head, the more likely you are to see the true signal. Finally, stay humble. The market has a way of humbling anyone who gets too arrogant. Understand the massive role that luck and randomness play in short-term outcomes. You can do everything right and still lose money. You can do everything wrong and get lucky. That's why you must focus on your process, not the immediate results. Did you do your homework? Did you think in probabilities? Did you consider the counter-arguments? If you did, then you made a good decision, regardless of the outcome. In the long run, a good process is the only signal you can truly control. Navigating the modern world of information is like trying to have a meaningful conversation in the middle of a loud, chaotic rock concert. The noise is overwhelming. But if you can train yourself to listen carefully, to filter, and to focus, you can begin to hear the music. Nate Silver's The Signal and the Noise doesn't give you a magic formula for predicting the future. Instead, it gives you something far more valuable, a mental toolkit for thinking more clearly and rationally in a world that is designed to confuse you. It's about developing the wisdom to know the difference between what's true and what just sounds good. And that, ultimately, is the secret to success in investing and in life.